Hey traders, Raghee here, and we're going to keep this video focused on one big idea, and that is the daily time frame. And I've talked a lot about day trading in the past few videos. I thought, you know what, let's talk about the daily time frame because we are getting closer and closer to the fall trading season. We're about 2 weeks away from the 1st of September, and that means we're going to see volatility volume start to resume sort of these non-summer, more normal levels, and we get the FOMC meeting, which kind of puts a sharper focus on everything. And there's a nice malaise we kind of have on summer where folks get to maybe sort of phone it in this last month of summer and no FOMC meeting. We did get minutes though. The minutes have not crushed the daily time frame of the broader averages. Dow, S&P, NASDAQ. It has not crushed these at all. Why? Because it seemed that the minutes reveal that the conversations happening within the halls of justice, within the Federal Reserve. Yes, I'm a 70s kid, super friends. It appears that the conversation is mostly when are we going to start to slow the rate hikes? And this actually falls in line perfectly with a peak and plateau of December being the last rate hike. There's some look, but very minimal, and certainly not the majority in terms of Fed Fund futures expectation, but a very minimal expectation for February. But it looks like it's a December peak, 3.5 to 3.75% Fed target rate probability, and then plateau. That means, gang, buy the dip is back. We've talked about this since July 7. So this is nothing new. We're a good 5+ weeks into this conversation. But the last week or so, the last few days, right? This is where it gets really good. It's been about a week. I think on the 11th, the Dow turned into an uptrend. And then you take a look at the S&P. Right around the same time, on the 9th, the 10th, the S&P turned into an uptrend. And the NASDAQ. August has been a good month for buy the dippers, right? Waiting for the uptrend to resume. But the 5th of August was when the S&P turned into an uptrend. They've all traded through their 200 exponential moving average, and they are all bullishly structured with the 8, 13, 21, and 34 EMAs. That sets the stage. Macroeconomic trend pointing to a path of least resistance to the upside since the beginning of July. Fast forward 1 month to digest this, and the equity markets have begun to rally. It is a little suspect, but most of it's timing, right? It's just when we know what we know. It just happens to have been the last most doldrum month of summer, that meaning August. So yes, I'm going to want to see that as we go into September, that trend is still going to be intact, but I'm in buy the dip mode. We can buy the dip, gang. I mean, this is where a lot of folks ask me, Rob, what do you think the market's going to do next? It doesn't mean that we're up, and away from here. It doesn't mean we're never going to have another down, significant regression to the mean. So let's talk about what a regression to the mean could mean. The Russell could be a conversation at the 200 exponential, but I'll be waiting for the 21 exponential, or my preference for what I look at as the mean is the 34 EMA wave, which is really a regression zone between the 34 EMA high to low, which are the green and red moving averages on my chart. As long as we stay double green, this is going to be the approach. So yes, gang, buy the dip is back. Macroeconomically, path of least resistance to the upside, because even though we're still hiking, we know where it ends, right? It's not whether or not they're going to continue hiking. It's the certainty that the market wanted to know is, when are you going to be done? When are you going to start talking about tapping the brakes? We've got both of those very now in the minutes and very visibly in the Fed Fund futures in place. And we can already see the equity markets have been front-running this. Guess who else has been sort of front-running this reality? Bonds. Yeah, bonds aren't up, but they're not heading significantly lower. The downtrend broke in July. This means bonds are ready to start moving higher, reflecting the expected lower yields, right, that we'll start to see as we take a look at the September contract, right, as we go out into the December contract as we go out into next year. So the expectation, I'm not saying bonds are just up and away from here either, but bonds are not moving lower, reflecting the higher yield just because the Federal Reserve is continuing to hike rates. Bonds have already discounted that. They're definitely in a holding pattern. There's no doubt about it. And if we can get above the 200 here and go double green as the equity indices have, that would be awesome. But that's the direction I'm looking at this market, gang. So buy the dip is back. This is what I'm doing next. Regression to the 34 EMA mean zone. I'll see you in the next update.